This video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Alright, hello and welcome to Camel Finance. I'm your boy Camel and this is the weekend's deep dive. On the weekend, we like to come back and re-examine the base case hypothesis of the channel, which I've held for around 2 years now. So we're going to run through this thing from the top. Starting off with the stock market, my idea at the lows was that everyone was too bearish. We would have a blow off top to all-time highs. We would see rate cuts sometime around the top, and then we would enter a global bear market and recession. I do believe we have reached an extreme in terms of sentiment. It doesn't mean we couldn't reach a higher extreme, but you can see that the percentage of respondents expecting stock prices to rise over the coming year has reached levels not seen since the early 90s. When we fast forward to today, it seems that we have completed 3 angles and are now breaking to the downside. We also got the rate cuts sometime around the top, if of course this was the top, which of course begs the question, doesn't it? Are we about to tag this second angle, bounce up it, and then break down? Because if we do, that is me calling tops, declaring the tops are officially in, and the second half of this hypothesis, which is the global recession and a bear market, would likely become the focus of this channel. Something else to note is Congress may well be banned from owning stocks at the top. It's not a prerequisite or a requirement for this idea to continue to play out, but we did see the exact same thing back here with the Fed. They banned the Fed officials from owning stocks for ethical reasons. They always frame it under the context that it's not fair to the public, that these people get to insider trade. But really what we observed here was it just turned out they let the Fed officials out at the top before a bear market. And so I was suggesting for a while, we may well see a repeat at the top here. What's really interesting is the AOC and other politicians from both parties have now introduced this new bill to ban stock trading by congressional members. So right as the stock market apparently is heading into some kind of distribution, potentially going to be looking to grind the second angle and break down, we also seem to have Congress thinking about letting themselves out at the top. For Bitcoin, the idea was pretty simple. I was calling for an earlier than expected top and thus an extended bear market decline since there'd be more time left in the cycle to reach that 4-year cycle low. You can see from this chart from Tony the Bull, this is kind of the base case idea. Okay, originally I was expecting something like this to occur, and I had to move the goalpost a couple of times since we never got a true breakout of this range until of late, where of course we have had that true breakout and now sitting somewhere around 100k. Now, if this is going to continue to play out, then we really do need to see Bitcoin start to squeeze to the upside very, very pronto. Otherwise, it's going to have morphed into a look more like this. We may have to entertain some more severe downside scenarios if that is to play. If, of course, the stock market is going to break down and we are going to have a global recession and a bear market, we would expect to see inflation completely disappear and move towards deflation. This is a major point of contention in the markets at the moment, since the majority of market participants are thinking that this 1970s repeat is on the table, something akin to this. And I've long been making the case that if the stock market really is going to complete a top and a bear market, we will likely see the resumption of disinflation before ultimately a short period of asset price deflation. Now, at the moment, this is a point of contention since CPI and inflation in general have been ticking up over the last few prints, leading many investors to suggest that I'm wrong about deflation and what we're going to get is a repeat of this 1970s fractal. This week, we have got a new CPI and PPI dataset coming out, and I've been suggesting for the last couple of prints that we can tolerate sticky inflation for perhaps this week's print and the month after. But after that point, we really should expect, if I'm correct about deflation, to see the direction change in the inflation data set. So if we get to this week's print and perhaps next month's print and we start to see a top come in for inflation, then I think what we can suggest is something akin to this, which is before recessions take hold, we often get a little bit of a spike up in CPI and PPI before ultimately the recession takes hold and we move towards disinflation and deflation. Same here, a little pop up in inflation, recession takes hold, and down we go in the inflation. You can see the same here, a little pop up, recession takes hold, and down goes the inflation. We got the same thing here right before the C19, a little pop up in inflation before ultimately it was crushed by a recession and a demand destroying event. And so if that is what we're going to observe, a little pop up over the next 2 prints, followed by a sharp reversal as a recession takes hold, then I can stand with this idea. However, if what we see is this week coming, the next month, and the month thereafter start to continue to print higher highs in the inflation data, then of course we will have to invalidate this as an idea and it will look an awful lot like this repeat is on the table. This week we also got new job data come out, and the job data was a lot stronger than most people were anticipating. We also saw the unemployment rate drop to 4.1%, but in spite of all of this, the markets continue to sell off, largely because the dollar and the yields continue to rally, which pressures risk assets. It's also of note that most people are well aware by now that this is probably going to get revised, since that's what they have a history of doing over the past 12 to 18 months, and that this data is probably not as trustworthy as they would have us believe. When we look at the Sahm recession rule, currently printing a non-recessionary 0.4. It's a print above 0.5 that is considered a recession indicator. Although with that said, at the hard right edge, we continue to make higher highs and higher lows. So until such time as we can set a new lower low here and buck this trend, it still to me seems like we've got a lead-in phase before acceleration when that recession kicks in. A lead-in phase before acceleration before the recession kicks in. We've seen this time and time again, a lead-in phase, recession takes hold and we get acceleration. So I don't think we can just breathe a sigh of relief here and say this is nothing until such time as we see a new lower low. We also know that the PMI, okay, is in recession territory, as you can see, occurred in all prior instances. So once more, the writing continues to be here on the wall for everyone to see, and we've got home builder spec inventory reaching insane levels, okay, not seen since the GFC. A spec, remember, is a home constructed without a buyer ready, with the intention to sell at completion or during construction. So they are building homes right now and there is absolutely no one to buy them. Very, very similar setup to what we saw back here. And again, if this thing is to continue, you best believe we're going to be in a recession in no time. We're also noting the consumer continues to be suffering and we're getting rejection rates rise for credit cards, mortgages and auto loans. And the Fed uses the yield curve to be able to predict recessions. Historically, a read above 35% saw the onset of a recession within 12 months. Right now, we're sitting at over 60% probability, telling us to be open to seeing a recession in the not too distant future. And the reason I want to flag this particularly today is because they use the yield curve spreads, such as this 10-2 right here, to be able to predict recessions. Everyone always gets this wrong. They call for a recession when we get an inversion. They call again for a recession when we get reversion. But the detail that is important here and gives us the signal is it is acceleration to the upside, okay? Defined by higher high and higher low closes on the weekly time frame that is synonymous with actually seeing the tops come in for the stock market. And when we zoom in on this 10-2 yield spread, okay, we have currently got acceleration as defined by higher high and higher low weekly closes. And remember, all of this is occurring against a backdrop of the stock market breaking down from its third angle. And for an even sharper signal, we can use a 10-year 3-month. Okay, the reason this is sharper is you have even less time to react. In the case of the dot-com bubble, once we started to get acceleration in these yield spreads, the top was already in. By the time we got the acceleration in the yield spreads, the top for the GFC was already in. And by the time we got true acceleration, we saw the top come in for the C19 era. And when we fast forward to today and take a look, this is starting to show all the familiar hallmarks and symptoms of acceleration at the hard right edge. Again, with the stock market breaking down from its third angles, continuing to set new lower lows. So unless we get some relief and a bounce here very, very pronto, we are at risk, of course, of grinding this second angle before ultimately breaking down. And if we do so, I have to officially declare the top. So when we pull up an S&P 500 chart, you can see we may well be on our way to completing this yellow squiggle of mine, which suggests we're going to have to entertain that this really was the top. Now, it's always possible that we didn't find a cycle low here and instead have found it here, and then we can get a rally and a breakout. We'll have to remain open to that. I had a hedge long position here just in case I was wrong about this whole idea and the market was going to rip higher. And if so, then the best way to be wrong about something is to make money whilst doing it. But we've had to pay a stop on this position. And to me, this is starting to look exactly how I'd expect it to look, getting ready to lose that second angle. It's also noteworthy that Dow Jones lost its second angle as of Friday's close. So the structural damage is slowly but surely taking hold here. Also note the Russell 2K fired a warning sign by closing below its upward sloping red support line. So as always with these trades, I give them 1 or 2 days space. But if this thing can't recover the trend line by about Tuesday, then you will see me cut this trade and lock in the profit. And I would suggest to you that there probably is not as much upside left here as most people would have you believe. And of course that fits with the sentiment having reached an extreme not seen since the early 90s. The story for gold is a little bit more positive. Gold appears to be breaking out and trying to confirm a weekly cycle low. It may have to throw a retest into a daily cycle low, but ultimately I do expect gold to do well here. Bitcoin is completing at the moment breakdown, retest and possible resumption to the downside. And the worst part is if this trade is stopped out, it will also qualify as a failed daily cycle. Now for the Camel Crew, it's not so bad because the profit from the first trade will be locked in once this one's taken out. But notice how if this is the case and this cycle is to fail, we'll be heading down to a daily and a weekly cycle low, and so will the stock market. Now in theory, these weekly cycles and daily cycles are tradable. They're high probability setups, and we should expect at least in the worst case scenario a few weeks of upside out of those weekly cycle lows. But by the time we get down here, particularly in the case of the stock market, we will have completed 3 angles, broken down from 2 of them. And even though you will probably see me go long here because we should get at least some decent relief out of this low, I would be thinking since we'd lost the third and the second angle by then, we'd expect this cycle to left translate and fail. And then all of this would just fit with the base case hypothesis that we were going to have a big blow off top and then come tumbling down in a global bear market and recession. So things really need to get moving if they're going to get moving now. And of course, all of this is occurring against a backdrop of the Dixie continuing to rip higher, despite a sea of people out there calling for much lower Dixie. This is starting to look very, very deflationary, and they are going to have to do something immediately if this is going to stop. Otherwise, what we're going to get is this exacerbated to the upside as people are forced to flee risk assets and hide in the short-term safety of the dollar. To make matters worse, we have got the yields continuing to rip higher. So the backdrop right now is very, very conducive to a risk event. It's very, very conducive to seeing a nasty correction here in the best case scenario, and in the worst case scenario, a bounce to a left translated and failed daily and weekly cycle out of that weekly cycle low in the late February, early March timeframe. So things can change, and they can change quickly, but at the moment they haven't changed yet, okay? Unless we can touch this second angle and come ripping out of here, then I think we need to be much more open to these downside scenarios than most people would have you believe. So I'm your boy Camel. I hope you found value here today. If you're a level 3 member, look out for the members only video I'm going to post for you guys. Other than that, have a fantastic weekend. All the best. Cheers. Bye.
Camel Finance, he's the man to see. Rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame. Sticking to his guns in his money game. He's a badass, oh yes indeed. Camel Finance got the markets key. Taking a stormy